Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making the move, and what to expect for the future. Today is September the 1st, first day of September 2023. It is now 4:10 p.m. Central Time. The bond market and mortgage-backed security market is closed for today, over the weekend, and as well as Monday. They are not operating over Labor Day, so Monday there will be no report. I'll get back to you on Tuesday, but check this out. We were talking the last few days about a big report coming out, which was the Bureau of Labor Statistics employment reading that really judges employment, hirings, firings, things like that, and the health of the jobs market. Now, the Federal Reserve has been really looking at this as one of its key indicators, even kind of trumping the CPI, PCE, PPI, and other reports that they usually rely on heavily. They've really been pointing towards employment as too strong to say that the economy is cooling to the point that they would like. So take a look at this report. Now, you remember we talked about that we wanted a number of 185,000 or less, and we wanted to hear that we were under expectations, cooling, difficult, things like that. We didn't want to see that it came in hotter. That was the word we didn't want to see, hotter than expectations or above expectations, because that would show strength in the market. Now, I'm going to show you a little trick here on how you can really make a lot of things in your life a lot better here. So stay tuned. I'm going to teach you something that's very cool. So check this out. Let's go over here. Heading into Labor Day weekend, Biden celebrates the new job growth. Friday's job report from the Bureau of Labor Statistics comes in at 187,000 in August, beating estimates of 170,000. Now, interestingly enough, last time I checked, the estimate was 185. So somehow it turned into 170. So that was hotter than or over the expectation, which now is 170. All right. So, but here, take a look. But while you're celebrating that, the unemployment rate, however, was 3.8%, a jump from July and the highest since February of 2022. Okay. So we're celebrating a number that I'm going to show you is arbitrary. So we're celebrating that we were over 170,000. Well, what type of a benchmark is this 170,000? No, all it is that somebody's saying, I think we're going to come in about 170, and it come in at 187, so we're going to have a party. Now, why are we going to have a party when at the end of the day, whatever this person estimated, whether it came in higher or lower, unemployment went up? It is an increase to the national unemployment rate. This is not good. This is not a good employment number, but we can celebrate anything as long as we look at it the right way, right? So let's take a look over here at another little chart that I thought was very interesting and telling. All right, so this here is supplied to us from our friends over at MBS Highway, Barry Habib and all of his team, and he received this from some of the people that he pays attention to. But this is what I like to look at. Look at the average job gains. Okay, this is job gains. Okay, so in 2022, the average was about 399,000 a month. Very hot, double what they would normally be happy with. The 12-month average, the last 12 months, is 257,000. The last 6 months, the average was 194,000. The last 3 months, it's 150,000. So are job creations slowing if we've gone from 399,000 average per month down to 150,000? Yes. Job creations are slowing tremendously, okay? And unemployment is going up. So the employment game isn't looking that great, although they talk about it all the time. And this is the thing I want to talk to you about, a new way to look at life, okay? Like, this is something I didn't realize I could do. All right, so if I'm going to have a goal, let's say that, I want to lose weight or something like that. Everyone always equates it to that. So if I say, look, I am going to lose 10 pounds in 3 months. Okay, in 3 months goes by, I lose 10 pounds, and I'm gonna have a party, right? I'm gonna celebrate, and we're gonna have a huge party. Now, next time I'm gonna say, well, I'm not feeling that great, so I'm gonna say that my goal is 5 pounds, but we're gonna have a party. We're gonna have a party when I lose 5 pounds, just like when I lost 10 pounds, right? And then now I go, man, I'm really tired, and I haven't been liking this new diet thing. My goal is 1 pound. And then I lose 1 pound, and we're going to have a party. And that's what you're seeing here with these charts here. They're celebrating the fact that they had 87,000 jobs, and it beat an estimate of 170,000. But they have no mention of the fact that before they were seeing 399,000 a month. All right, so it's very easy. You can see how it's subjective, and you can look at things different ways. What does that mean as far as the charts for the day? Well, even with this report coming out with a headline reading that the employment number was hotter than expected, we're still only down 9. Now, again, we did not want it to come in hotter than expectations. It did, which is not good for mortgage-backed securities and bonds. So we are down 9 on the mortgage-backed security. But even this is a little tougher. We're up 8 on the 10-year treasury. We don't want to see that creeping back up to 420. We don't want to see that. Now, part of this, again, we've had a very good run the past week and a half, 2 weeks. We've had a good run bouncing off of what was a Fibonacci level here, which was our floor of support. And now we broke above this Fibonacci level here at 98.716, kind of flirting with or fighting with the 50-day moving average, and then now kind of still hanging out right here about this Fibonacci level. But where are we? Also in the week, we are on a Friday, not only a Friday, but a holiday Friday, which means for 3 days, investors aren't going to be able to respond as quickly to movements that happen in the globe. So any type of global occurrences that happen, market occurrences that happen, it's more difficult to make moves in order to respond to those things over weekends, especially holiday weekends. So what do? You take some of your chips off the table, right? And you pull back a little bit, maybe say, hey, I'm just going to sit this one out for a few days, and that money can come back into the market when we come back on Tuesday. How are home loan interest rates responding to that? Let's take a look at the Brent Bruce Daily, the very well-qualified 30-year fixed conventional home loan available through brokers and through Rancho Capital. Let's take a look and see here. So, again, this is a 30-year fixed, 800 FICO score, 25% down, personal primary residence, single-family residence, 7.25 with a $61 credit. Okay, so this is pretty flat, right? We've been flirting with 7.25, 7.375 with different amounts of credit for the past past week at least. Let's open this up here at the Loan Store, still leading the charge, really trying to stay out in front. And if you want to get down to the sixes with the Loan Store, 6.875 is costing 0.792. If you want to get into the fives, or we'll just say 6%, 3.762. That's, I think, up a little bit from yesterday. Let's take another look here at our friends over at United Wholesale. 7.25 is costing $1,303. So they're not leading the pack when it comes to a 0-point loan. 6.999 is costing 0.608. I think that yesterday, it was in the 0.5 range, wasn't it? Like somewhere right in that range. Very, very close for that 6.999 to where it is today. 5.999, 3.314. I think that's an improvement from yesterday. We were more like 3.5, somewhere in that range. So good things going on there as far as the buy downs getting a little bit closer. All right, let's open this right quick here to the parameters that we're taking a look at here for the Brent Bruce Daily. We always want to put that up for compliance purposes. All right. Now, make sure that you like, subscribe, share, and hit the notification bell in the bottom. I will get back to you on Tuesday. Have a great Labor Day. We'll see you then.